Hey everyone, I'm the lead analyst here at Finance News Frontier, and welcome to today's Explainer. Pull up a chair and make yourself comfortable, because today we really need to have a serious kitchen table conversation about something completely bizarre happening in the global economy right now. We're going to break down the May 2026 market paradox, and I promise you, what is actually happening beneath the surface is going to completely change how you look at the stock market.
So, I want you to just consider this for a second. The world is on the brink of a massive energy war. So, why did the stock market just hit its highest level in human history? It's a paradox that literally makes zero sense if you follow the old rules of economics. We're witnessing what some analysts are calling an $800 billion infinite money glitch that's keeping Wall Street alive while parts of the world are, quite literally, burning. Let's dive right into this. Here's the thing. We're seeing a complete and total divorce between the real world and Wall Street right now. Look at our current geopolitical reality. The Strait of Hormuz is functionally blocked by Iranian forces. A fifth of global oil flows are choked off. And we saw Brent crude briefly spike to $115 a barrel. I mean, it's the largest oil supply disruption in history. But then, look at the market reality. The S&P 500 and the Nasdaq just shattered all-time records in early May 2026. It's a total disconnect. Main Street reality on one hand, Wall Street euphoria on the other.
So let's take a step back and look at the bigger picture. We really have to understand why the old rules of panic selling are just completely broken today. Normally, a major war in the Middle East and a massive spike in oil prices means investors panic, they dump their stocks, and they run for the hills, right? But look at the numbers from May 5th and 6th. The S&P 500 closed at a record 7,259. The tech-heavy Nasdaq pushed past 25,000. And what's actually driving these numbers? The technology and materials sectors are responsible for 70% of these massive gains. Basically, investors have made a collective decision that the AI supercycle, the massive global build-out of data centers, chips, and automation, is simply way more important than a regional war. They are looking right past the conflict toward this perceived golden age of technological innovation. And you can really see just how staggering that market confidence is when we look at the commodities. Brent crude is up almost 57% since the conflict began. Historically, an oil shock of this magnitude would absolutely crush the stock market. It would trigger a massive recession, just like it did in 1973 and 1990. We even have Project Freedom happening right now, where U.S. destroyers are actively escorting commercial ships through the strait amid active missile fire. It is a highly volatile situation. And yet, the market is just brushing it off. So you've got to ask yourself, why isn't the U.S. economy crumbling under these fuel prices? Well, it's because of one absolutely crucial factor. The United States is now a net exporter and the world's #1 petroleum producer. This is huge. Domestic energy production has effectively shielded the U.S. economy from the worst of this crisis. We just aren't reliant on foreign oil the way we used to be, and that creates this massive decoupling effect. The market doesn't panic over Middle East energy volatility anymore because the U.S. is largely insulated from the supply shock. It's a structural change that has fundamentally altered the rules of global finance. Now, what's really surprising here is something we call the AI circular economy. This is where it gets really, really interesting. We're pulling back the curtain on something the mainstream news is largely ignoring, and it explains exactly how these tech valuations have gotten so astronomically high. Here's how this $800 billion web of circular financing actually works. Step 1. A big tech giant invests billions into a specialized neocloud startup. Step 2. That startup takes that exact same investment money and uses it to buy highly expensive chips and cloud services from the original big tech company. Step 3. The big tech company reports explosive revenue to Wall Street. NVIDIA did exactly this with a $2 billion investment into a company called CoreWeave. OpenAI is the center of a massive loop involving Amazon, NVIDIA, and SoftBank. These tech giants aren't just selling AI organically, they're effectively financing their own revenue streams. And the sheer scale of this? It's mind-blowing. $400 billion. Let that sink in. That is the estimated annual spend on AI infrastructure right now. To put that massive number in perspective, Amazon alone is planning to drop $200 billion on capital expenditures for AI just this year. That is a 150% increase in their infrastructure spending in only 2 years. The capital flowing into this space is honestly unprecedented in modern economic history. But, and this is a massive but, here is the jarring contrast that you really need to take away from this explainer today. 95%, that is the current failure rate for enterprise AI implementation in the real world. So, Wall Street is being propped up by the illusion of this massive, unstoppable AI boom. But out in the actual corporate economy, 95% of these projects are failing to launch or failing to generate a real return on investment.
Which brings us to a fascinating and, frankly, a pretty concerning concept, the dark fiber 2.0 thesis. Analysts are pointing out a 4 to 5 times gap between what companies are investing in AI hardware and the actual industry-wide revenue being generated, which right now is less than $100 billion. This perfectly illustrates a parallel to the 1990s telecom bubble. Back then, companies spent billions laying dark fiber internet cables that just sat completely unused for years. Today, tech giants are building server farms and buying their own revenue, creating a massive risk of stranded assets if real-world demand doesn't catch up to the hype. All right, let's move on to my predictions for 2026.
So, what does this all mean for the future? We've seen the geopolitical chaos, we've seen the hidden loops propping up the tech sector. Let's move confidently from analyzing the facts to forecasting the market's next move. First, I'd absolutely expect to see a dark fiber market correction, specifically hitting these neocloud providers in the coming months. As Wall Street wakes up to the circular financing loop, clean revenue, and by that I mean money coming from genuine, arm's-length customers, not startups you just funded yourself, is going to become the only metric that matters to investors. Second, I'm predicting a highly pragmatic commodity for tech deal at the upcoming Trump-Xi summit in Beijing. Because, if history is any guide, these high-stakes geopolitical summits during times of economic pressure usually yield some kind of transactional breakthrough. Watch the May 14th to 15th summit. It will likely result in a massive trade. China really needs to stabilize its economy, so I'd expect them to agree to buy record amounts of American Boeing aircraft and agricultural products. In exchange, the U.S. will likely pause its technology export restrictions, specifically the affiliates rule, allowing certain chip sales to proceed. It's a pragmatic deal that directly benefits the American AI industrial complex while easing some of those trade tensions.
Which leaves us with the million-dollar question, will the bubble burst? We've looked at the massive spending, the decoupling of U.S. energy, and the hidden financing loops driving this bizarre market paradox. So I'm throwing it over to you. Are we witnessing a genuine technological revolution that actually justifies the S&P 500 hitting over 7,200? Or is this $800 billion circular financing loop just a high-tech Ponzi scheme waiting for reality to catch up? Let me know in the comments if you're buying the AI hype or if you're buying the geopolitical fear. I would love to hear your take on this. Thanks so much for joining me at the table today, and I'll see you in the next explainer.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.